Hi, I'm Jeff Rosenkranz, Fixed Income Portfolio Manager with Shelton Capital Management, here to talk about interest rates and the outlook for credit markets. Interest rates have risen substantially already this year, but at this point we believe that the risks are much more balanced. There's a significant amount of Fed tightening already priced into markets, with between 6 and 7 25 basis point interest rate increases already priced in. And that's a lot of hawkishness. Certainly inflation is a huge problem, as we've been anticipating for over a year now. But we believe that the data will actually start to improve over the coming months. The base effects or year-over-year comparisons become much more challenging this spring, because it was really last spring, as the economy and society reopened, that things really took off. So we should start to see some improvement this spring in certain elements of the underlying inflation data. At the same time, the housing data, the way it's collected, there's a significant lag in terms of how quickly increased housing prices and rent flows through the inflation data. So unfortunately, that's going to continue to be a problem for much of this year, even into 2023. But the rise in interest rates in the market, mortgage rates and consumer credit card loans, is going to start to slow the economy a little bit. Higher prices for goods and services will dent demand a little bit. And there's really a huge effect coming from the runoff of all the stimulus we had last year. Including the child tax credit, which has been a huge help for a lot of families. So we think at this point, we should start to see some improvement in some of the underlying inflation data. At the same time, there's a tremendous amount of hawkishness already priced into markets. We certainly think the Fed is going to start raising rates in March and continue to do so relatively steadily throughout the year, but they may pause to see if their policies and other elements of the economy are having the desired effect. We don't think it's just a straight shot to 175 or 200 basis points of rate increases. So we're going to be watching the data just like they will, but at this point, the risks are relatively balanced. We see room for spread tightening in high yield credit and a compelling total return opportunity for the balance of the year. If you have any questions about our outlook for interest rates, inflation, or the markets, please reach out. Thank you very much. Be well.